Welcome to our CFP exam prep discussion focusing on estate planning, specifically the extended payment provisions for estate taxes related to closely held business interests. Today we're diving deep into sections 6166 and 6161, which are crucial elements that often appear on the CFP exam. Let's break down section 6166 first. This provision allows qualifying estates to pay estate tax in installments over up to 14 years when the closely held business interest exceeds 35% of the adjusted gross estate. Many test takers mistakenly think it's 15 years or confuse the percentage threshold. The first installment of tax is due 5 years after the regular 9-month filing deadline, and then the remaining payments are spread over 10 annual installments. Here's a practical example. Imagine your client owns a manufacturing company valued at $2 million, and their total adjusted gross estate is $5 million. Since the business represents 40% of the adjusted gross estate, they qualify for Section 6166 treatment. This means their heirs can defer a significant portion of the estate tax payment, which provides crucial flexibility for business continuity. A common trap on the exam involves calculating interest rates. Under Section 6166, there's a special 2% interest rate that applies to the tax attributable to the first $1 million of business value adjusted for inflation. The remaining portion accrues interest at 45% of the regular underpayment rate. Test questions often try to trick candidates by applying the wrong rate to the wrong portion. Moving on to Section 6161, this provision offers a different type of relief. It allows for up to a 10-year extension for paying estate tax if the executor can demonstrate reasonable cause and hardship. This is broader than Section 6166, as it's not limited to closely held businesses, but the interest rate is less favorable. Many students confuse these two sections, so remember that 6161 is the more general provision with the shorter time frame. When preparing for the exam, pay attention to the qualification requirements for closely held businesses. For corporations, the decedent must own at least 20% of the voting stock, or the corporation must have 45 or fewer shareholders. For partnerships, the 20% ownership requirement applies to capital interests. Test questions frequently focus on these threshold requirements. Another critical point to remember is that the closely held business interest must be an active trade or business. Passive investments, like rental properties or portfolio management, typically don't qualify. The exam often includes scenario questions where you need to determine if a business qualifies based on its activities. Let's address acceleration rules, which are another favorite exam topic. If too much money is withdrawn from the business, or if there are missed payments, the remaining balance of deferred tax becomes due immediately. Test questions might present scenarios where you need to determine if an acceleration event has occurred. To reinforce these concepts, think of sections 6166 and 6161 as lifelines for business continuity. Section 6166 is the specialized tool for significant closely held business interests, offering longer deferral and better interest rates. Section 6161 is the general hardship provision with broader applicability but less favorable terms. Remember, the exam writers love to test the specific requirements and calculations related to these provisions. Focus on the percentage thresholds, qualification requirements, and interest rate calculations. These details often make the difference between choosing the correct answer and falling for a tempting distractor.